This is Tom Nunemaker with Capital Discussions. This is my trading update for Tuesday, August 26th, 2014. We're looking at the volatility for the last 2 days, and the VIX, cash VIX, is at the bottom in the colored open, high, low, close bars. The VIX futures, the next 3 months, are these horizontal lines I'm highlighting, and you can see in the legend those are the September, October, November futures, and the red is the S&P E-mini futures. So today we opened higher, went a little bit higher, and came back down and closed, well, still trading at 1998.75.50. Now if you look at the SPX, here's today's SPX action. Closed over here yesterday at 1998.31, within striking range of 2000. And where do we open? Boom, right above 2000. Had a little bit of happy juice. Everybody was liked that we were over 2000, came back down and kind of stabilized and closed almost exactly on the nose at 2000. So that's the market. Let's take a look at the positions. Well, actually, before I do that, I also want to show you the euro because I put a trade on with that today. So here's the euro. It's at a 3-month low, probably even more than a 3-month low. Let's put on a year. Okay, now this is interesting. I'm trying to get data, but it's not giving me any data. I do see Interactive Brokers has quotes, but they're not moving. But I am online, I just checked it. So I don't know, maybe Interactive Brokers is, I don't know what their problem is right now, but anyway. Let me go to option view. I can pull up a price chart there. So here is the euro on a daily chart. Let me get rid of the volatility. So we really haven't been this low for a while. So the last time we were here was September 2013, so almost a year ago. We go to a weekly chart. Yeah, it was down around low 120s for a while in 2012. Looks like we're kind of heading back down that way. So I wanted to put on a trade because the volatility, if you look at the vol, is actually spiked up a little bit. So I figured now is a good time to put on, some kind of short vega trade. So I thought, why don't I do kind of a Weirdor, or Jeep, whatever you want to call it. I tried to get filled on the calls, but the market was selling off right at the end after I got this stuff filled. Then it sold off a little bit. I'm actually down a little bit, mostly due to slippage, because the futures, I don't know if I can see the bid-ask on here. Let's take a look. Okay, the futures must be closed right now. Interesting. Okay, well this is on the Globex, so no, maybe I'm just not getting data for some reason. But so if you look at the futures options on the quotes, you'll see a bid and an ask price. Now this is 41.43, but you can't buy at the mid price on these futures. It's all electronic, so you're either going to buy at the bid or buy at the ask or sell at the bid. That's the way these work. So good luck trying to get the mid price of 117.5. You're not going to do it, and you can't do spreads on here either. So a little bit of a pain, but I thought, I still like the futures, and I live in Europe, so I watch the euro all the time. So I wanted to get a position on. So what I did is I sold the 10 delta in November, 74 days out, bought some long puts to protect it so it's not, it's defined risk. And then after that got filled, then I put on the hedge. And then I tried to sell some calls, but the market drifted down a little bit and got away from my call price. So what do I have left is this, which is kind of half a Weirdor, if you will. And we're down again, mostly through slippage, and moved just a little bit, not much, from when I got the first part of it filled. And you can see it is defined risk down here. Now the max risk at expiration is, what is it, 22,500 almost. But this is span, risk-based margin. And if you look, even if I crank up the volatility, let's see, to 6.1, it's still 1.5 standard deviations from problems at expiration, which is 74 days away. So it's pretty far in the future. Now, let's look at the returns on this, and this is why futures options are kind of interesting to me. If you look at the return above the upper long put on the hedge, right? Let me just get rid of the extra lines here so you can see it clearly. I'm going to zoom in a little. Okay, so what is this? This is $467 profit, and what's our margin? Our margin is $26.87. So if we go 467 divided by 26.87, that's a 17% return on the call part of it. So that's actually a pretty nice return, isn't it? Now obviously the margin will increase if the market sells off, because these lines are going to start going down, and as they take their range of movement for the span margin calculations, as your risk increases, so does your margin. So if we assume it's never going to get to 22,500, let's just say worst case it gets to half of that, or say 12,500. So if we do that, 467 divided by 12,500, that's still a 3.7% return up here. And if it goes down in this area, then that's a pretty nice return. So that's my trade. It's a longer term trade, 74 days, but pretty high probability of profit. Option view is estimating 94% probability out of the gate. So with no adjustments, that's where we're at. And we can actually enhance this. So as the time window shrinks on this, say we get to 37 days and it's looking like this, and maybe the market's moved over to this area, then we can take off that put debit spread hedge for maybe, let's see, what do we pay for it? That's 89, so 49, so 49 times 0.75, so about 37. So we would capture, most of that, 75% of that, and get it back and add it into the profit. So that would just lift this up a little bit more. It can give us even more return. So pretty nice trade. I don't think the euro is going too much lower for short term. I could be wrong, obviously, but I think it's historically it tends to make moves down like this and stabilize for a bit. So I'm hoping it's going to do the same thing. It's sold off. There's some longer term support here, I guess you would say, if you're into technical analysis. But if I look at the birdie on here, I got a long way down for this thing to go. It's a good looking trade, I think. So now let's move on to the next trade. Okay, here's the SPX trade that's going to expire in 18 days on September 13th. If you remember, I took off all the puts because I was basically maxed out on that part of the trade. And if you remember, I had this. Well, actually, let me just show you what it looked like. So, oops, I'm going the wrong way here, sorry. Alright, so this is what I had left, that little small call credit spread, guaranteed profit of about 1,000 with a chance to make another 500. Now, I just wanted to lock in my profit, so I could have just closed it, but instead of doing that, I put on this butterfly, just added the other half of a butterfly, basically added this to the +1 -1 I had. You give me a net 1 2 1, which is a butterfly, and that looks like this. So if I compare the two, you can see I was basically locking in my profit, basically essentially closing the trade. But if SPX happens to be nice and wants to give me a gift between 2000 and 2010, especially 2005, I could increase the profit a little bit with taking really not much extra risk. I think here 12.22, and today we're at 12.56. So I'm risking $30 to maybe make another couple hundred, which seemed like a pretty fair trade-off. Now, obviously, probabilities of profit and everything. Let's see, pretty good chance it's not going to be a 2000, but if it is, that's nice. But I've essentially closed it out. There's no margin required on this, so it didn't really cost me anything to do this. So again, I could have just closed the trade, but instead I added this bearish call vertical to my bullish call vertical and created a really tiny butterfly that gives me a little extra profit potential if it falls in between these two. So just, I can't lose any more than $30 on this, so I was willing to do that. So the next thing we have is a December trade, and this is similar to the one Jim put on. Jim and I were talking about it. He calls it his Christmas tree trade. You can see it's up $70 already, and I put it on earlier today. So here's my original prices that I paid for this, and I was trying to stay to the 25-point strikes because that's where the main trades are. And if I right click and do open interest, there's a lot of contracts here on these strikes. So actually I got filled at the mid price, believe it or not. So it was like $2 what I got filled at, and here's the trade. Again, it's a very narrow butterfly if you look at the standard deviations. Okay, so there's 2 standard deviations. It's pretty narrow. However, remember, if it does start moving away, there's a lot of premium in this thing. So one thing you can do is, say the market starts moving down, well, just peel off part of this side of the butterfly. Maybe do something like this. Buy 2, sell 2. And what is this? This is a bearish call vertical, right? And that would raise that up and give you profit in this area. So because there's so much premium, you can actually do that kind of thing. So it's actually a pretty interesting trade for a trader, or you can take Jim's approach where you just throw it on and look when this thing expires right before Christmas. So he calls it his Christmas tree trade, right? Looks like a little Christmas tree expiring right before Christmas. So you could just say, okay, I did a 10 lot, I think Jim did a 15 lot, and you could just let it go. I spent $2,000 on this trade. It could make a lot more, even at this T plus 58, which is the halfway mark, there's a 60% chance of making some money on it. And if it's in this area, it could be up $1,500, $1,600, which is a pretty nice return on a $2,000 investment. So you could just let it go. If it starts motoring, you could again start peeling off part of that side and raise up the side where the market's at and give yourself a pretty good chance of making money. So kind of an interesting trade. So I thought, well, let's do that. It'd be good for educational purposes. And it's also, I think, a high probability that this thing will make some money. So the last trade to look at is a new trade I put on today. This is another SPX broken wing butterfly. So let's see what we have here. Okay, let me get rid of those. Okay, so I'm about a 21.5 delta. I'm using the option view, wrong one, define, the model, there we go. I'm using the option view pricing with the true delta, which is going to be a little different than your standard delta, and I find the option view delta is actually pretty accurate. Now if I look at these deltas on Interactive Brokers, this one is the 1965 put, which is here, and they don't have the delta here. So let's see, they're saying the 1970 put is a 29.6 delta, which is here. So IB is calculating the delta about 5 delta points higher for this put. So they would say this is maybe a 26, 27 delta. But option view's true delta is minus 21.6, and I'm pretty comfortable with the true deltas. Now the thing with delta is different brokers and different vendors are going to calculate it slightly differently. And if you start comparing, oh, my option view delta is 21, but my Interactive Brokers delta is 28, and then when should I adjust? Well, whatever you're using, just use that one system. Just make it consistent. So if you're using option view, always use option view. If you're using interactive, always use interactive. If you're using toss, always use toss. So this is my delta that I sold my puts at. Now I did an 8 lot, so this was a 8 by 16 by 8. And I went 65 points instead of 60 points, again, so I could get right on the 1900 put versus 1905. Because my guess is there's a lot more open interest there. There is, look, 10 times the open interest. So I figured I'd have a better chance of getting filled on this one. And let's look at the volume. So 137 versus 5,000. So I figured, oh, pretty good chance I'll get filled on this. So that's the one I did, the 1900. So I went 65 points out. And that gave me 8 by 16 by 8, something like that, which would look like this. Now, I'm gonna, oops, pull it in so you can see. That must not be right. Oh, I forgot these. Huh, no wonder. That looks better. Okay, so let's expand that so you can see it more. Okay, I like to look for where 2 standard deviations and 1 standard deviation are. If I can see it, then I know where the end is. If you have something like this, where it just goes to the end, I don't know where it is. So if I pull this over, okay, there it is. That's 2 standard deviations. Now I have a definite point to look at, on the chart. I'm not guessing how far it is. Okay, so this is the trade initially, and you can see it's defined risk. And then I added in the hedge. So what did the hedge do to it? It did this. Now let's look, actually let's do this so you can compare it. Okay, so if I compare these with and without the hedge, the existing is with the hedge, both is without the hedge. So without the hedge versus with, we're knocking our delta down, 18 delta points, and you can see that if you compare 39 to 21, so we're taking off 18 deltas, which makes sense. Our gamma goes down a little bit, which is nice. Our theta is nearly unaffected, and our vega goes down a tad. Now that's a good combination to have your vega and your gamma reduced and your delta. Those all help you if the market starts going down quite a bit. Doesn't seem like it, but if it's moving down, 30 points, it really adds up quickly. So here's what our position is now, right now. And it's a really flat T+0 line. If I zoom in on this, I can adjust this volatility to move this T+0 line right on top of that dot. So if I increase it 2 points, oh, that was a good guess. So right now it says we're down $17 and there's 478 to make. Over this range, you can see it's quite a nice profit zone of $2,000 plus down in this area, and 1,000 from about here and below. So this is kind of the line we're playing for, T+12. So about 12 days, this would be a really nice place to be, wouldn't it? So that's kind of what we're looking for. This actually doesn't even have to be above 0 because you're not really playing for this line, you're playing for this line. So that's the trade I put on today. Expires in 24 days, maybe a little bit shorter than I wanted, but I didn't want to put one on here. I don't know why. Oh, yeah, I know why. I wanted to put one on this expiration because this is where all the volume is. And again, if you look at the volume and the open interest, and you compare them to these weekly options, the weekly options on the SPX still have pretty good volume and open interest, but the open interest doesn't even pale in comparison. I mean, 130 versus 35,000, 58 versus 25,000. It's pretty significant difference. So if you're trading those monthly expirations, especially on the 25-point strikes, pretty good chance you're going to get nice fills. And again, I got filled at the mid price on my 8-lot butterfly, boom, just like that. So there's enough volume on those monthlies that, pretty good chance of getting a good fill. So that's it for today. Coming up Thursday is Amy Meisner. In fact, let me just show you on our schedule. Okay, so the calendar. Amy Meisner is talking about her nested iron condors on Thursday. If you'd like to sign up for that, you can go to our main website, which is capitaldiscussions/blog, and you'll see the link right here, Roundtable with Amy Meisner, and it's also on these latest articles, so Roundtable with Amy Meisner, and then there's a link. You can go click here to register, and then that'll take you to the page that has more information about it. And there it is. I didn't have a good picture of Amy, so maybe one of these days I'll get one. So that's in, a little bit less than 2 days. Some of the things we'll go over. Click the button, pop in your name, and then you should be good to go. Now, as far as what else is coming up besides that, I talked to Michael Benklefa today. He's written 3 trading books on options. I think he's managing some money with his company, Othello Consulting. But he has a book, his latest book, Think Like an Option Trader, and it's basically how changing your mindset from being a stock trader to an option trader. So he's going to talk about that on the 4th of September, so right after Labor Day. And 2 weeks after that, I've gotten Greg Harmon, who also wrote a book. He's a Dragonfly Capital. He's going to be speaking on using technical analysis to design winning options trades, and I think that's the name of his book. And they're also available on Amazon, etc. So should be interesting to hear from these guys, and I hope you sign up for it. I'll have sign-ups on our blog probably in the next day or so for both of those. But if not, you can always come here and join the meeting, and I might create a link you can sign up to get the automated email reminders too. So anyway, that's what's coming up, and let's hope these trades go well, and I'll talk to you tomorrow. Thanks.